Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own but still want to be educated through the process. This is the Monday, September 15, 2025 edition. Let's get started. We start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Despite September typically being a more difficult month for the stock market, we are off to a great start. We're up about 1.92% for the 2-week period, and there just doesn't seem to be anything slowing down the market. However, if we take a look at what's actually driving the stock market, we can attribute 88% of the gain to 5 companies. We have NVIDIA, Broadcom, Alphabet, which is the parent company of Google, Tesla, and Oracle. All of those companies, well, four of the 5 companies having double-digit gains for the 2-week period. But those 5 companies made up 88% of that weekly or the 2-week gain. So again, very interesting to see what actually drives the market as opposed to just thinking like everybody is participating in the up or down market. If we move on to interest rates, we're taking a look at interest rates as measured by bonds issued through the U.S. Treasury Department. These are the preeminent measure of investment risk. We factor interest rates into every valuation calculation. So generally speaking, if interest rates are going down, we expect stock prices to go up, and vice versa. If interest rates are going up, we would expect stock prices to come down. This is showing where we are as of Friday, September 12th, this green line. Each dot is an interest rate for a given maturity length. So interest rates listed over here on the left axis and the maturity lengths on the bottom. We can see that for the short-term maturity lengths, we did see a moderate decline over the past 2 weeks, not so much in the medium term or what we would categorize as the belly of the yield curve. We also did see some declines in the longer term yields, the brown line being where we were 2 weeks ago. What's interesting to us is looking at where we were 1 year ago. Short-term rates were at 5%, and what we would call a very heavily inverted curve, where the short-term rates are higher than the longer-term rates. Finance theory suggests that you should be compensated for a longer period of time that you're investing the money. So typically, interest rates for 10, 30 years would be paying you more than the short-term rates that mature in less than a year, for example. So we definitely have a hinge right here at the 2-year interest rate, 2-year yield, where we have very, very small changes today versus a year ago. We're seeing these short-term rates come down significantly, and we're seeing these medium and long-term rates going up significantly from where we were a year ago. And we anticipate we'll continue to see that over the next year. So the short-term rates getting pretty close to 4%, we would expect those to be even lower a year from now, probably closer to 3%. And finally giving us more of that normal yield curve where we see the interest rates going up as the maturity lengths go out. But something to keep in mind is the savings accounts and money market funds and CDs that you're investing in. Those interest rates will be coming down. The bank won't be advertising that those rates are coming down like they do when they're going up and they're trying to get you to invest and lock in your money. So if the Federal Reserve does cut rates here this week, it would just be interesting to see, pull out your statements and check to see what interest rates you're getting, and let's have a conversation to determine if you still feel like those rates are sufficient for what your goals are with the cash that you have there. As these rates go lower, probably closer to 3% over the next year. Again, we can have that conversation of whether or not 3% is enough, 3% per year, or if there's other areas that we can invest in to get you a little bit more. Speaking of the Federal Reserve, currently the interest rate is between 4.25, 4.5%. We are expecting a reduction of 0.25% here at the meeting September 17th. And we're actually expecting almost fully priced in three rate cuts between now and the end of the year now. So a 0.75% reduction between now and the end of the year. We can make a case for a larger increase this week of 0.5%, then taking October off and then going again in December. But given who is running the Federal Reserve, who's the chairman, and who are the current board members, we think that their preference is going to be 0.25% at each of those three meetings instead of doing something larger. All right, for our expectations and implications portion, we want to keep this brief, but we want to take a look at the consumer as we discuss our expectations. So again, our gross domestic product, our economy, how we measure the economy is predominantly consumer based. So 68% comes from people like you and me going out making purchases on various goods and services. So how we are doing as individuals and what we're spending money on has a lot to do with where we're going to invest your money. The consumer for a 25-year average, we see a 1.7% increase in consumption on an annual basis. As of the second quarter, our annual increase was only about 1.1. So there is some growth, but it's not as much. It's below average. Okay. We're seeing some vacillations between imports and exports and business investment, which we assume will continue throughout the year as we're adjusting to the new tariff policies. But by and large, how much money we spend and how much we increase our spending has a lot to do with whether or not we have a job and we're getting pay raises, etc. So as far as the labor demand side, we've got job openings that have fallen back to a pre-pandemic level. We did have two times as many jobs as we had people looking for jobs in March of 22, and that has since corrected itself. The number of people who are quitting their jobs for various reasons, usually to take another job, has also dropped to pre-pandemic levels, and the number of people getting laid off we see is creeping up back to the levels that we had pre-pandemic as well. On the labor supply side, we're seeing some significant revisions to our payroll numbers from the Bureau of Labor Statistics. A year ago, we had a net revision, downward revision of over 800,000 jobs. And just this week, we had a revision of over 900,000 jobs for the annual period. So that works out to about 75,000 jobs per month. So where we felt like the economy was doing relatively well and the labor employment side was doing relatively well, turns out not doing as well as we had thought. So the fact that the stock market continued to do well and hasn't had a significant sell-off in light of this news tells me that there's something else going on behind the scenes. There's got to be some other reason why the stock market is doing well despite the labor market not looking so good. We've said in the past that the stock market is not the economy. I also heard people say this week that the labor market is not the economy, which makes me scratch my head a little bit because I think it has more to do with the economy than the stock market, but everybody's entitled to their opinion. So currently, we have a 50-year average of unemployment just over 6% and wage growth of 3.8%. As of August, our unemployment rate's at 4.3, so well below average, and our wage growth is pretty much in line with that 50-year average. So not too much that I'm concerned about there. What I am concerned about on consumer finances, we can see the breakdown of where we're getting our assets as individuals and what our liabilities are. Student loans in this bottom right corner is showing early delinquencies, right? These are balances that are more than 30 days delinquent. And once we started collecting on student loans again here at the end of President Biden's term, we can see that student loan delinquencies have essentially skyrocketed from basically zero up to about a 15%, or anything that we saw pre-pandemic. So that's concerning. We're also seeing increases in mortgage delinquencies and credit cards and auto loans. Everything is drifting higher. Fortunately, those three categories are still below where we were in the financial crisis, and kind of in line with where we were pre-pandemic. So nothing really concerning there. But the student loans is one where we're feeling a little antsy about it. Finally, this is our CPI, Consumer Price Index inflation report. Just want to point out that food at home and our dining, recreation, and other service categories increased in inflation in the August reading, 2.9%. Headline CPI is actually it's below the 50-year average, right? We're not seeing runaway inflation by any means, but the Federal Reserve does want inflation closer to 2%, not 3%. So we are going in the wrong direction at the moment, but it is comforting to me to see that shelter inflation is coming down, auto insurance inflation is coming down, et cetera. So we're seeing a little bit of adjusting, but if we are trying to have jobs and have wage growth, and we're spending more money just on the basic necessities, like food, it becomes a little bit more challenging. And if we have to make a trade-off of whether or not we eat or we pay our student loans, then I think we're going to default on um, or default to buying food and default on student loans. So again, concerning. I don't know what we're going to see as a resolution to the student loan situation, maybe a refinancing of those somehow. But that's kind of so on the expectations portion. We still think inflation has a little ways to go before it peaks again and comes back down. Some of the tariffs are going to get passed through to people like you and me and what we're spending. So maybe over the next 6 months, we'll finally hit a peak before it starts coming back down in 2026. The stock market is, we believe, pricing in more productivity. We still have the big beautiful bill that is making its way into the economy, and we've got some good tailwinds as far as the stock market's concerned. We're wondering on the labor side if now that we're getting into artificial intelligence and whether or not the companies are able to be more productive with fewer people, and or if the people unemployed looking for work don't have the right skill set for the new economy under artificial intelligence type rules. So again, a lot of things that we can work on or that we would hope get themselves worked out. But as far as the stock market, as far as investing is concerned, we're still feeling pretty uh, optimistic about investing, and we're not seeing anything currently that is giving us enough stress and anxiety to say we need to pull out and go to cash or something more conservative with your investments. All right, as a final word, coming to the end of the summer, which is kind of nice because it sure feels like I'm constantly doing yard work or taking care of the landscaping around my house. We bought a new lawnmower this year, and we're actually taking care of 5 yards at the moment. So, um, I had someone talking to me about the investment landscape earlier this week and talking about how that is our way of trying to figure out what's going on and how do we invest based on what we're seeing. And I guess if we try to use an analogy, it's, there's always some trimming, there's always cutting grass, and there's watering the dry spots of the yard, and trying to identify where we can, give a little bit more time and attention. And ultimately, we want things to grow. We want to let things develop the way that they're supposed to. But in order for it to have the right look, we want to make sure we give it some time and attention. So we will be doing rebalancing. That's part of the ongoing maintenance that we do, just like we do with yard work. We're also looking to try and get annual reviews done between now and the end of the year, ideally before the holiday season. We can do those in a variety of ways. We don't have to do face-to-face. We don't have to do Zoom, but we'll be reaching out, trying to figure out what would be best for each of you guys in your individual situations. Next couple weeks, I'll be out of the office a couple times. My oldest is getting married, and that'll be on the 25th of September. So I'll be out of the office on that day, taking care of all those fun activities. So thanks for tuning in. Thanks for working with us, and we're going to continue to do the best we can, and we'll talk to you soon.